My name is Rakesh Rao, Executive Editor of First Construction Council, welcoming you all for the today's webinar on real estate sector trends and outlook 2025. So before we proceed, uh, I will just explain how we proceed, we are going to proceed for today's webinar. After the initial 10 minutes presentation by me, then we will start with the presentation from the industry expert. We have today three people, Mr. Prashant Thakur, Mr. Devesh Shah, and Mr. Vimal Nadar. So after their presentation, we will take the questions. And request to all, just keep yourself on mute and keep your cameras off during the presentation. With this, I think I can start with my short presentation to you. So it just explains the First Construction Council to all the participants. Hope the screen is visible to everybody.
Yes.
Yeah. Thank you. So the First Construction Council is an infrastructure think tank focusing on providing the latest updates on the construction industry in India and is dedicated to promoting the causes and the needs of the industry. It is governed by a board of governors who are distinguished industry leaders such as D.K. Sen, Mr. D.K. Sen of Larsen and Toubro, architect Hafiz Contractor, Mr. Pradeep Singh of IDFC. Then we have Mr. Vinayak Pai of Tata Projects. Then Sandeep Singh of Tata Hitachi, Mr. Sanjay Seth, Senior Director TERI and CEO of Griha Council. Mr. Subodh Dixit, former Executive Director, Engineering and Construction Division of Sapuji Palanji. And Mr. Smith Banerjee, who is the ex-MD and CEO of ACC Cement. So the members of the council benefit in more than one ways. This includes industry networking opportunities, knowing consumption trends, understanding the market condition better, and access to growth opportunities. And how do the members achieve all this? Through white papers. That we bring out on a frequent basis on various industry segments, and also through various various events, physical events like conferences, industry awards, and exhibition. So in the first quarter of the this year, we will be having three important events. So for starting with third Metro Rail Conference on January 22nd, which will bring together the industry leader, policy makers, urban planners, and technology experts. So that is on the 22nd of January. Then on 12th of February, we have AI Data Center Conference. As you know, Indian data center market is said to experience explosive growth, reaching an estimated 4.5 billion by 2025 with a CAGR of 12%, propelled by the entry of several developers like Hiranandani, Rustomjee, Embassy, etc. So the conference will discuss the booming market of data centers. Then on March 5th and 6th, we will be hosting Cement Expo Forum 2025 in Hyderabad with the theme of growing profitably. The event will also witness presentation of Indian Cement Review Awards to recognize the contribution of the Indian cement industry in the nation building. So here is a list of upcoming events which First Construction Council will be organizing in 2025. And today's virtual interaction is also a part of Council's endeavor to create a knowledge sharing platform for the industry. So in case anybody wants to join the First Construction Council or any of the events, please drop in your inquiries, anything on the any kind of information that you want on the contact given on your screen, that is contact@firstconstructioncouncil.com. So coming to the today's topic of discussion, As you know, in 2024, Indian steel real estate sector has demonstrated its resilience in the face of global economic headwinds, while emerging trends point to a dynamic and a promising future. In the first 3 quarters of 2024, India's housing market witnessed 115 million square feet being sold, with a sales exceeding 1,100 billion rupees. The office market in India has also continued its upward trajectory, registering a higher space uptake in the successive quarters of 2024. As 2024 comes to a close, the Indian real estate stands at a transformative juncture, navigating both challenges and opportunities. To understand trends and business opportunities in Indian real estate market, we have today with us three experts. Mr. Devesh Shah, Director, KR Ratings; Dr. Prashant Thakur, Senior Director and Head Research, NROC Group; Mr. Vimal Nada, Head of Research, Coolers India. So with this, let me close my presentation and invite our first speaker, Mr. Devesh Shah. So before he starts, let a few words about him. Mr. Devesh Shah is the Director Ratings at KRH. Mr. Shah has a total work experience of 20 years, of which he has been associated with KRH for over 16 years. He has worked in research and rating division of KRH and he is the vertical head of real estate sector. Mr. Shah is part of various rating committees at KRH and is an MBA finance by qualification. Over to you, Mr. Shah. You can begin your presentation.
Thank you. Good afternoon all, and good afternoon to my esteemed co-panelists. I'm Devesh Shah, and as said, I'm working for KRH Ratings, and I feel privileged to be a part of this webinar, Real Estate Sector Trends and Outlook 2025, organized by First Construction Council. At KRH, we do a lot of rating assignments, so we'll try and speak about how the segment is doing, while focusing more on the affordable housing segment and the credit outlook on the industry and the companies. So I'll start with my presentation. Is the presentation seen?
Yeah.
So the real estate sector in India has experienced significant growth, as said by you as well in the presentation, closely tied to the country's macroeconomic expansion. India's GDP grew at an average rate of 6 to 8% over the last decade and is expected to grow at 6.5% for 2024. This steady economic momentum has fueled demand for both residential and commercial properties. The government infrastructure push and initiatives like RERA, Pradhan Mantri Awas Yojana, and Swami Fund have also played a crucial role in driving the real estate growth. In recent years, we have also witnessed a remarkable shift in consumer preferences and industry trends. Buyers are increasingly seeking larger homes driven by post-pandemic lifestyle changes. The market is also witnessing rising property prices, majorly due to high land cost and increasing cost of construction. This high cost also puts pressure on the viability of affordable housing projects, resulting in reduced participation from private players and consequently fewer launches. This in turn has contributed to a widening demand-supply gap in the affordable housing segment and a declining share of affordable housing in the overall transactions. Additionally, sustainability is becoming a key priority with an increasing demand for green and eco-friendly buildings. This push for energy efficient and sustainable construction is set to double the green building market in India by 2025, appealing to the environmentally conscious buyers. Furthermore, with strong sales momentum and robust collections, developers are focusing on deleveraging to strengthen their balance sheets, positioning the sector for more stability and sustainable growth in the coming years. Together, these trends are driving positive consumer sentiment, which is expected to keep inventory levels close to 1 year. A bit on the industry perspective. As discussed, The real estate sector has experienced a broad-based recovery across all segments since the pandemic, but the residential market has arguably seen the swiftest and the steepest resurgence among all real estate segments. Over the past 5 years, the pan-India residential market grew at a remarkable CAGR of 21% from nearly INR 7 trillion in 2017 to INR 23 trillion in 2023. Key drivers include the rise of nuclear families, urbanization fueled by job growth, and government initiatives like RERA, Swami Fund, and Housing for All. Additionally, infrastructure projects have enhanced connectivity, while higher paying jobs and rising disposable incomes have improved affordability. Looking ahead, the market is projected to grow at about a CAGR of 8 to 9%, reaching INR 42 trillion by 2030. Notably, the top 6 cities, MMR, Mumbai Metropolitan Region, NCR, National Capital Region, Bengaluru, Pune, Hyderabad, and Chennai, currently contribute to 4 to 5% of the units sold, but 15% of the sales value, which is expected to reach to 19% of the sales value by 2030. If we look at the demand across India in the top 6 cities across the last 5 to 6 years, in line with the pan-India growth, the sales volume in the top 6 cities have also grown at a healthy CAGR of 20% since 2020 and culminated in a 10-year high in 2023. So the dark blue line represents the sales and the turquoise line bar represents the launches done in these 6 cities. Increased savings during lockdowns, minimal income disruptions in mid and high income brackets, and a robust economic growth forecast have fueled demand in the residential real estate market in India. The residential market sustained its momentum as it stepped into 2024 with sales in 9 months 2024, witnessing a year-on-year growth of more than 30%. CareEdge expects both sales and launches to be about 3.5 lakh units in the near term and inventory overhang to remain at 5 to 6 quarters. The growth momentum is projected to persist due to robust demand. Though the Indian real estate is emerging as a preferred investment avenue amidst market volatility, the demand primarily stems from end users as the significance of owning a home has become more prominent post-COVID-19. As we have seen, the sales are rising and the launches being in tandem with or not keeping actually with the sales. The property prices are on the rise. So due to strong sales momentum, as I said, and reduced inventory overhang, preference for larger sized units with amenities, increase in input costs and higher land prices, the rise in property prices was inevitable. Prices rose by approximately 8% nationwide in 2023, with Hyderabad and Bengaluru experiencing the highest growth. However, despite the increase in prices, buyer sentiment has remained unaffected so far. Based on the expectation of sustained sales momentum, CareEdge estimates that rates will continue to rise between 5 to 8% in 2024, largely driven by the end user market. If we look at the trend, there is a shift in consumer preferences towards larger size residential units with good amenities and sustainable living. This is also evident from the growing share of luxury segment, which increased to 42% in the 9 months of this calendar year, driven by rising income levels and a growing trend of home buyers upgrading their existing homes. So what led to the growth of luxury housing, or what could be the challenges to the affordable housing? So I'll give some perspective on that. While there has been a noticeable shift towards luxury segment, the mid segment is holding steady. As we saw in the earlier slide, the mid segment holds steady. Though affordable housing is seeing a decline in its share due to several structural changes. One of the key factors is the limited availability of affordable land within city centers or well-developed areas. As urban land becomes increasingly expensive, it becomes more difficult for developers to take on affordable housing projects in prime locations. Consequently, many such projects are being pushed to the outskirts of the cities, where the lack of sufficient infrastructure, connectivity, and amenities can affect buyer interest, leading to higher levels of unsold or vacant units. In addition, the high costs associated with construction present significant barriers for private developers in the affordable housing segment. The limited private sector involvement further complicates the situation, as government initiatives alone may not be enough to address the demand supply gap. With estimates suggesting a shortage of around 10 million affordable housing units, this gap could widen substantially, potentially reaching 30 to 50 million units by 2030 due to rapid urbanization and population growth. Another critical challenge is the financial sensitivity of the affordable housing customers. These buyers, often from the economically weaker or lower income groups, are highly susceptible to fluctuations in the interest rates. Even a marginal increase in borrowing costs can deter potential buyers, as it impacts their repayment capacity and overall affordability. I'll give a credit perspective. So this data we have collected for a few listed players. And one of the prevalent themes that we have witnessed post-RERA implementation and demonetization is the growing consolidation in the industry. Timely project completions, focus on sustainable projects, use of technology and cost efficiencies by these players is adding in healthy sales momentum. With the shift towards reputed and organized developers, coupled with high sales growth, the pre-sales, that is the booking value of top listed players, grew by 27% during FY19 to FY25, a CAGR of 27%, collectively surpassing INR 1000 billion or INR 1 lakh crore or INR 1 trillion by FY 2024. We have also observed high sales velocity during initial stage of project launch by these developers, which is unlike the pre-COVID scenario. The robust collections are driving deleveraging. So we have plotted here debt, which is in the blue bar, which has been declining. Collections is in the turquoise color, and the two line charts depict the leverage. Debt by collection is how we measure leverage, or debt by market cap. So we have taken the summation of the market caps of these entities, and how does that look like? So developers have efficiently utilized collections to manage their debt, reducing gross debt from rupees 50,000 crore in FY19 to about rupees 33,000 crore in FY 2023. With new launches in FY24, gross debt increased to about rupees 43,000 crores. However, the gross debt to collection ratio has remained consistently below unity. We can see that at 0.76, 0.60, and 0.65 over the past 3 years, despite an absolute increase in the debt levels in FY 2024. The deleveraging is also a result of developers maintaining financial discipline, focusing on sales rather than holding the inventory, optimal mix of land buy versus joint development agreements, and raising equity. Over the past 3 years, the key listed developers have raised more than rupees 30,000 crores through IPOs, QIPs, and preferential issues. That is where the ratio is at 0.08, which we see over here. This is the credit ratio that CARE Ratings calculates for all the portfolio and also for the subsegments or the industries that it rates. It is defined as upgrades by downgrades. So ratio of 2 indicates there are 2 upgrades for every downgrade, and we do not take into account the reaffirmation of the ratings. So the credit ratio, as I said, is the ratio of upgrade to downgrade for a specified period. It is CARE Ratings credit ratio and not for the entire credit rating agencies of India. As seen from the chart, here the credit ratio has improved from below unity, which is to be 0.73, 0.40, and 0.33 up to FY21, indicating that there was only 0.33 upgrade for 1 downgrade. And the ratio has moved to 3.10 and 2.25 times, or which is more than 2 in the last 3 years. This implies more upgrades than downgrades, unlike the extra years. The positive shift can be largely attributed to the improved performance of real estate developers. As the economy recovered from the pandemic and began to stabilize, developers demonstrated robust financial health and operational efficiency, leading to a favorable credit ratio. The way forward. To summarize, demand growth is expected to extend to Tier 2 and Tier 3 cities. Developers will persist their focus on sustainable projects while maintaining financial and operational discipline. The robust economic growth, infrastructure push, and demographic dividend will play a vital role. Thank you.
Thank you, Mr. Shah, for your excellent presentation. So, if anybody has a question, please type in your questions in the chat box. We'll take it up towards the end of the program. So, with this, I would request our next guest, Dr. Prashant Thakur, on this virtual platform. So, Dr. Prashant Thakur is the Senior Director and Head Research of Anurag Group. He is the seasoned corporate strategy and management consulting professional with the experience of over 18 years. Prior to joining Anurag, he worked for consulting majors like Deloitte and Ernst & Young, and then ventured into the startup ecosystem. He was instrumental in setting up the research and data operations verticals at companies like PropEquity, CommonFloors.com, and QuickHomes.com. With this, I would hand over the stage to Dr. Thakur. Over to you.
Thank you. Thank you for this quick introduction and a warm welcome to all the participants who have logged in. And just give me a second. I'll share my screen. Is the screen visible?
Yeah.
Okay. So, what I'm going to do in next 10 minutes is quickly walk you through what is going on in the Indian real estate and how the transformation journey has helped and what are the driving forces that is shaping up this industry. So before I move to my other slides, I wanted you to just the audience to give a highlight of the total value of real estate under construction and what was the percentage of overall residential share. So as of 2009, if you would see, the value of real estate under construction, which included residential, commercial, and warehousing, stood at 94 billion, which as of 2023 stood at 361 billion, which was a massive jump of almost 3x. But one interesting point to note in this slide is that while in 2009, the share of residential was 49% of the overall of real estate under construction, and your commercial accounted for almost 51%. Now in 2023, you will see that the mix has changed. 85% of value of real estate under construction was residential and 15% was commercial. So that it was a tectonic shift towards residential, and then it also can be attributed towards the resurgence of this sector post introduction of RERA and other regulatory reform. So this slide basically captures the journey of real estate, how it has transformed from 2013 when it was more or less regulated. So what I've done is I've broken down the phase in terms of fearless, which was 13 and 14. And the reason I call it fearless is because this sector was not at all regulated. Anybody with land parcel and good political connection could become a landlord. And that's why you saw a huge amount of supply coming in. And then most of these supplies either were, mostly on the papers, either they were not approved, but since there was no regulator, the supply came in. And then slowly what we saw a scenario of oversupply and the projects getting stuck because of, funds being diverted to some other projects or into land acquisition. 2015 to 17, I call it regulated because that's where RERA, demonetization, GST and IBC came into the picture. And that's the reason you'll see the red bar, which shows supply, and the green bar, which reflects the sales. You see the difference from 15 onwards. The supply started to come down, and the primarily, the prime reason for this decline in supply was that post RERA, all those dubious players exited the market because RERA prohibited them to launch and market any projects until unless they got themselves registered with RERA after getting all the approvals. So that's why you saw a huge amount of consolidation happening. All those grade D and then, unregulated player exited the market. Then from 18 to 20, I call it control plus outlier because, During 19, what we thought was that now the impact of all those regulatory changes are settling down, and then things would start to improve. Unfortunately, in 2020, COVID hit us, and that's why you see that 2020 was, almost a washout year, both in terms of launches and sales. Surprisingly, if you see, right after COVID, we saw a huge amount of, comeback that was made by this sector. And we have seen a steady uptake. And in fact, in 2023, we formed a new peak, both in terms of sales and launches. So that clearly signifies that the market bounced back after the huge cleanup that we saw during the RERA and GST monetization, and also during the COVID phase. Lot many weaker players exited, and now what we see, the market is being driven by grade A and corporate developers. RERA has made the market very disciplined and transparent. And post-COVID, I think most of the home buyers who were sitting on the fence, they realized that this is the best time to buy a house. And during the uncertain times, they realized that having a physical asset is an important thing to have in their portfolio. And that's why we saw a huge uptake. So up to 9 months of 24, what we have seen, almost close to 357,000 units have been sold, and 321,000 units have been launched. So we have seen that momentum has continued, and it is expected to continue in the coming years as well. So quickly, if you look at quarter-on-quarter, sales and launches, I think Q1 of 24 was the new peak that we formed in terms of launches. The subsequent quarter shows some kind of decline in launches as well as sale, because the second half of let's say 24, we saw state election as well as general election, which kind of delayed approval process for lot many developers. And since the new launches declined, the sales also kind of took a tapered. But in the next slide, I will show that while the volume took slight dip, the value of residential real estate that we saw was on the upper side, thanks to huge price appreciation that we have seen. So quickly, which of the cities are performing in terms of launches as well as sales? So this slide basically compares the 9-month data of 24 with the same period last year, and this slide is reflecting the new launches in terms of units. So I think MMR and Pune and Kolkata saw a dip. Otherwise, all the cities, they saw an uptick in the launches in terms of number of units. Now, this slide captures the sales in terms of unit. So NCR saw a decline, and MMR, I think, has been a consistent performer. It saw an 8% increase. So except NCR, Chennai, and Kolkata, all the cities, they registered some kind of uptick in the sales. I think this slide captures how the mix of the launches have changed over a period of time. While in 2018, 40% of the launches accounted in the affordable segment. That segment has now kind of really come down and stands at 17% as of now. Interesting point to note is that the share of luxury and ultra luxury has almost seen 3x jump from the 2018. So what we are seeing is that in this uptick, or let's say the rally that we have seen in the industry is primarily driven by projects which are priced 1 CR and above. So which typically I would say in this uptick, somewhere the budget segment has lagged behind, and the reasons are quite obvious. The impact of COVID on the upper segment of the population was not that much. And since the buyers of affordable segment comes from unorganized sector, and they mostly work in SMEs, this is the sector which is still, yet to fully recover from the impact of COVID-19 financially. And also what has happened is that when the industry bounced back right after COVID, the land prices went up, the input cost went up, the labor cost went up, and hence the developers are also shying away from launching affordable projects. And what happened is that the CLSS scheme that was kind of really driving the affordable scheme through Pradhan Mantri Awas Yojana was also withdrawn. So these were the couple of factors that led to deacceleration of affordable segment. What we have seen is that over a period of time, the size of the unit has increased. So if we compare it from 2021, we have seen a 28% increase in the overall size of the apartment size. And this is primarily to do with what we have seen post-COVID, that everybody wants that extra space in terms of, let's say, which they might use as some work from home, or let's say some kind of school from home kind of concept. So everybody is preferring 0.5, be it 1.5, 2.5 or 3.5. The prices have kind of really shot up, if you see. So what I have done in this slide is that I'm trying to show the price from 2005 to 2012, and overall we saw 53.5% jump. Then during the period 2013 to 19, we saw a price jump of 12%. And from 2020 to 9 months of 2024, it was, on a country average, it was 49%. So there was a massive price run up that we have seen. And that is reflected in this slide, where I'm trying to show the value of real estate sold. Earlier, I showed in terms of unit. Here, I'm trying to show in terms of value. So MMR accounts for 42% of the real estate, residential real estate sold across the top 7 cities. And in spite of slight dip in number of units, what you would see that in terms of value, we have registered a 23% annual increase. And if you look at all the cities compared to the same period last year, they have shown a strong growth in terms of value of residential real estate sold. The good part is that this slide captures the inventory overhang in months. Almost all cities, if you see, have inventory overhang of less than 2 years, which I think is a very healthy indicator. And based on that, we can clearly say that, in coming periods, since the inventory overhang is so low, we might expect some strong launches coming in 2025. The slide is not changing. Yeah. And what we have seen is that strong completion and handover of units are happening. So in this slide, what I've captured is number of units that are getting completed yearly, and then that is being delivered. So for example, in 2023, we saw a record of 4.4 lakhs units getting completed and delivered. Similarly, in 2024, close to 5.3 lakhs units will be completed and will be delivered. This slide quickly captures. This slide captures the announced launched pipelines of listed developers at the start of FY25. So collectively, close to 253.16 million of plant supply was announced. But as of first half of FY25, only 23% of that plant or announced supply has been launched. So which in fact indicates that we might expect a good amount of supply to hit in the coming years. This is the last slide with which I wanted to conclude. So while, we have been hearing a lot that, listed grade A developers are doing great and they have, a good amount of market share, which to an extent is true. But if we look at this slide, the grade B players, which are represented in blue, still occupy a significant share. And this happens, normally when the market is pretty strong, every, landlord becomes a developer. But a point of caution is that when the market hits the turbulence, these are the, grade B developers who are, the first one to get into trouble. So I wanted to just, kind of end my presentation with this slide to kind of show the, the distribution of share of grade B developers, grade A developers, and grade A plus developers. So with this, I would end my presentation, and we'll be happy to take any question that the audience might have.
Thank you, Dr. Thakur, for your detailed presentation on the residential market. With this, I would request our third presenter, Mr. Vimal Nadar, to for his presentation. So before he starts, a few words about him. Mr. Vimal Nadar is currently working with Coolers as the head of research and has over 17 years of experience. His area of expertise include conducting studies in the area of business assessment, demand supply analysis, market entry strategy, strategic road mapping, etc. in sectors such as real estate, cement, BFSI, and other subsectors in the infrastructure domain. Prior to his present company, he has worked with organizations like JLL, Cushman and Wakefield, and CRISIL. Mr. Nadar, you can begin your presentation.
Right, thank you, Mr. Rakesh, for the introduction. I'll just share my presentation and just please let me know if you can see it. Yeah, Mr. Rakesh, just confirming whether you can see
Yeah,
this.
yeah, it is
Right.
visible.
Right. Thank you very much. I think after we have spoken about the residential market, good evening, everybody. I think I'm here to give a quick roundup of how 2024 has been for India office, as well as talking about key trends that is expected to shape India office in 2025. So to begin, I think this is a quick summary of this is a quick summary and a snapshot of how India office market looks like right now. So Indian Grade A office has has grown to a huge 744 million square feet. And which are the bigger cities? So Delhi, which occupy Delhi, Bangalore, as well as Mumbai. These are the bigger markets in terms of stock. And overall, the India office market, I think, has continued its upward trajectory, registering a higher space uptake in successive quarters we have seen in 2024. There has been record-breaking leasing we have seen in 22, in 23, and we expect the record to be broken even this year. So we have already seen about 47 million square feet of leasing in Grade A office spaces in 2024, up till September. So the full year estimate we believe should touch or easily cross about 60 million square feet. 47 million square feet itself shows a 23% annual growth, which is a YoY growth over the same period last year. Supply largely follows demand, and supply has also seen a significant growth in line with demand. And interestingly, vacancy has remained largely stable. Vacancy has remained range bound at about 16.5 to 17.5% during the last 2-3 years, also indicating broadly a stable demand supply scenario. Rentals, on the other hand, so this is a very broader indication because what you see 101.3 is a weighted average rent at an overall level. So we cover about six cities, and Grade A office market. This is an average, so indicating that what is the trend like right now? It stands about 101. As we move ahead, we will also see city-wise rentals with divergent trends. And as I indicated, I think right now, given this momentum which we have seen in 2024, we easily expect that 2025 starts at a stronger note. The position should solidify in the coming year. Moving ahead. So we spoke about the demand scaling up. So as I mentioned, 2024 is expected to close at about 60-65. So now if you actually go back and see that what has been the annual leasing trends and how the market has scaled up over a period of time. So if we actually broadly look, given the constraint of time, I've not really depicted everything out here, but I think overall, if we look at the overall pattern from 2010 to 2014, Around the average annual leasing was in the range of about 25 to 30 million square feet average annual across the top markets. It moved up to about 35 million square feet, but during the period of 2015 to 2018, 2019, and excluding the slack years. After that, I think post COVID, I think we have seen a significant scale up in office demand and moving up to on an average 45 to 50 million square feet. So which is why we have seen record leasing in 2022 and 2023. And we expect that 24 should close at a stronger note, surpassing the level seen in 23. Another important observation or a trend which we have seen is the gradual sectoral shift which we have seen in the Indian office market. So it's a no-brainer that technology has been a main driver for pushing grade A office demand in the last more than a decade. And technology has been the mainstay and steadily occupied about 35-40% across if you talk about the sectoral pie, followed by engineering, manufacturing, BFSI. Over the last 2-3 years, at least, what we have seen, as you see on the right-hand side of the slide, we have seen a gradual and I would say a definite shift towards sectors moving away from technology. So when I say that, technology still remains a dominant sector, which occupies about 25% from the high of 40%. However, at the same time, so what has really taken up the space is BFSI has seen a significant surge. Engineering manufacturing has seen a significant surge over the last few years. Now, how does this add up? Because again, if you again look at one more dissection, which I will talk about, the domestic economy has remained strong, has exhibited strong and steady performance, which is driven by manufacturing activity, which is driven by services sector in-house. So which is why I think it has played well on domestic, the bigger India-based conglomerates as compared to the over dependence on external sector. So which is why we see BFSI picking up space, engineering and manufacturing picking up space. Over the next so we expect this trend to remain. So while technology will remain dominant, I think these sectors are definitely going to pick up traction. So before, again, I think I move to GCC. Another important thing to note is, I think if we talk about so we also try to dissect in terms of the demand coming from domestic origin companies as well as foreign origin companies. So foreign origin company easily occupied about 60-70% of the overall demand. So whereas right now we see, given the fact that I think BFSI engineering manufacturing is also pushing the demand, the contribution of domestic origin companies has also significantly increased and easily contributes about 40-50% of the demand right now. So GCCs have been gaining definite traction in the last 2-3 years. GCCs have always been there, I would say, in India in some form or the other, because GCC is again a form of outsourcing. I think from the point of basic, I would say basic outsourcing, which is voice-based outsourcing to data processing, we have come a long way. And today, foreign companies seek comfort in setting up their global capability centers across sectors, not only technology, but even other sectors. So why is India preferred? India is definitely preferred mainly because availability of talent and cost arbitrage, which plays a very important role in setting up GCCs. So if you see this graph, so steadily, I think the share of GCC in overall leasing has increased and right now stands close to about 40%. So which we expect that this is definitely here to increase and definitely will not, and surely will not, is not expected to reduce over the next at least a few quarters, at least 1-2 years visibility. And in terms of absolute terms also, we see GCC leasing has significantly gone up from say 13 million square feet and right now it stands close to about 25 million square feet. If we talk about where is this business coming from, as well as which sectors are driving, major contributors or major origin of business remains US, EU, and UK. And so, in terms of sectors, I think technology is the main, technology, BFSI, engineering, and manufacturing remain a key major drivers if we talk about the demand split between GCCs. Talking about outlook, what we really feel for 2025, I think after recording, if you look at the overall pattern for India office, I think 22 has been a record year, 24 has been a record year. So we believe that definitely this momentum will continue. However, overall market-wise, I think we expect this year to rather stabilize at these higher levels. And we believe that annual average leasing of, say, 50 million square feet or around 60 million square feet is a new normal. And India would see about 60 million square feet of leasing definitely in 25. So it's going to solidify this, I would say, growth as well as position. And so the need, so some of the trends which is expecting, so some of the one important structural change which we have actually seen in the last few years is over the last decade, I think in the office market has moved away from a supply-led market to an occupier-led market. So previously, the supply or the built-up structure used to define the type and the structure of demand. Today, I think especially post-pandemic, the evolving occupier behavior in terms of the need for type of space, the kind of space being built is defining the supply in the market. So which is why we tend to say that it is more like an occupier-led market these days rather than a supply-led market, which was there previously. So one important part of this whole transition of all this structural transformation is flex space. We all have been talking about flex. Flex, I think before by around 2018, 2019, formed about 5%, 6% of the overall leasing. And in an extremely optimistic scenario also, we never projected that flex will occupy about 15% of the leasing, which is today the case. And we expect that to move up to 20% over the next 1 year or so. So flex itself has gone through significant changes. And right now, core plus flex is like the new buzzword amongst larger conglomerates, even mainstream corporates. So what do you mean by core plus flex? So larger conglomerates, the takers of conventional space have gradually switching to core plus flex model, wherein I think they have a combination of conventional spaces as well as flex spaces. Flex spaces lends them major advantages, flexibility to expand, flexibility to downsize depending upon the market scenario, as well as I think with increasing adoption, and I think it has become it has already become a reality of hybrid spaces being there. I think core plus flex also plays a very important role for companies to adopt this strategy. GCC will continue to ramp up, and we expect that GCCs will drive about 40-50% of the overall leasing activity in the next 1 year or so. I've spoken about flex. When we speak about managed office solutions, it is nothing but flex space, but it's more used in the context of larger corporates. It could be enterprise planning, or it can be also referred to as managed office solutions. Space rationalization, I think, again, all this is in broadly is a consequence of changes in occupier behavior. Space rationalization has been evident, and a quick measure or a proxy to gauge this is if you look at the transaction sizes or the average deal size which we use in an assessing office market has rationalized at around 43,000 square feet in 2023 full year, which is like 11% dip as compared to 2019. At the same time, the number of deals, the volume of deals have also gone up by about 43%. What does this mean? The average size of the transactions come down. So the important reason here being companies are adopting split office strategies. They are also they are also splitting their offices. So wherein they're trying to set up smaller offices, which could be closer to the employee as well as different locations. So that's being one reason. Again, we see the rationalization in deal size. So we expect further moderation in deal sizes can go up to 40,000 or below 40,000 in 2025, as well as at the same time, the volume of deals is expected to go up. The other point is increasing green footprint. I think net carbon is a committed goal these days, and across corporates, be it developers or occupiers, are trying to embody in their whole mission statement. And we expect the new supply, which will be coming over the next few years, will definitely largely be green, fully green. And also there's an immense potential for existing stock as well as buildings to be upgraded or overhauled to become green, and that exists. So if we quick estimates show that at least 300 to 350 million square feet of office space has potential to be upgraded, of course, after incurring a certain level of capex. So these are broadly the trends which are expected to drive 2025, which is expected to stabilize the market at these higher levels. So the right-hand side table, we have tried to particular quantify as well as the scaling of the numbers in terms of sectors. So what we are trying to say is in terms of technology, the average annual leasing, this is in terms of million square feet in the last 3 years, has been about 15.4. And we have tried to project what will be the average annual leasing over the next few years. So clearly, as I was talking about, technology is going to remain largely steady. What's going to drive is engineering manufacturing is expected to see a pickup. Say an average annual was about 9 million square feet, is going to move up to 12 million square feet. BFSI is going to move to 11.5 from about 9.4. Flex is also going to see a significant rise. So these are the sectors to be watched out: engineering, manufacturing, BFSI, flex space, and healthcare. Technology is going to remain stable. As I mentioned, this just gives a more deeper perspective into the flex space market. What we have tried to say is what is the total quantum of flex stock, which stands at about and outlook for 2025. So when we say penetration, which is 8 to 10%, which is the penetration of the total office stock, which was below 5%, say 3-4 years back. And an interesting point here is, why do we say again flex space is scaled up in India? Because this number compares significantly higher as compared to other developed counterparts in the APAC region, including Singapore. So wherein the penetration would be still close to about 3 to 4%. And in terms of city-wise split, most of the stock is obviously there in Bengaluru. Pune is about 13%, but again, Pune enjoys a greater level of flex space penetration. An interesting point here, again, I think even technology, the interesting point, technology companies are also adopting core to flex strategy. And in fact, technology is also one of the key component driving flex spaces. So that was about India office. I think a special request was there to include something on electric vehicles, and I'm glad to share that we recently looked at EVs, and we did a report on EVs to take stock as to where does the market stand. We had done a report in 2021, and it was a good time to take a quick check as to how EV market has performed. So if we took a quick report card is in front of you, saying that the pace of EV adoption in India has been largely not as expected, because we had set up an ambitious target of about 30% electric mobility with 80 million EVs on road by 2030. This compares the current penetration actually stands at just 8%, because I'm translating into an EV stock of about 5 million. So thus, if you have to really achieve the target which we have set, we need an exponential overall 6x growth, which definitely we feel that is unlikely in all possible cases. But the positive side here is there is still a very focused attempt on the demand and the supply side. So hence we feel there would be a slight delay or potential delay, but it can eventually result in completion of the set targets. So out here, the table shows we have tried to split the type of vehicles: two-wheelers, three-wheelers, four-wheelers, heavy vehicles. And we have tried to give what is the current level of penetration which has been achieved and what is the targeted level. So definitely we see a very increased level of adoption in three-wheelers, which is a key message. But I think a major pickup is also required in passenger vehicles, which includes two-wheelers and four-wheelers and heavy vehicles. Talking about investments in EVs, I would say an irony is, though the pace of adoption has been slower, however, I think the stakeholders in the industry have been committed, and we have seen actually 3x increase in terms of committed investments, at least announced investments, which amounts to about $40 billion US, and which can potentially be deployed over the next few years. The pace of execution can vary. so over the next 5 to 6 years. And how does EV present opportunities for real estate? It is mainly can be translated, it can be looked at in two ways. One is land development, because EV manufacturing presents development opportunities, and we have estimated it can be to the extent of 13,000 acres of land by 2030, because land would obviously be utilized for setting up larger gigafactories, including lithium ion and EV ancillaries. And the other real estate potential would result from charging infrastructure, which has been estimated to the extent of 45 million square feet by 2030. Because there will be a need for dedicated charging stations that landlords and developers can outsource as a separate or a bundle service to operators, resulting in incremental opportunities. So that somewhere summarizes the EV space right now. And yep, that's all from my end. Thank you. Happy to take questions.
Yeah, thank you, Mr. Nadra, for your presentation. And with this, the floor is open to questions. We already saw a couple of questions from Mr. Avinash Shukla. I think there are a couple of one interesting question I would rather ask him to raise. It's regarding the affordable housing. I am not able to see what he means by still old 10 lakh plus units are unsold, are not observed. Mr. Shukla, can you elaborate on what you actually want to ask in that question?
Hi everyone. Thanks to all three eminent people presenting the scenarios and the real-time data for last 1 decade, and more importantly after COVID. The data we have been listening about these data, and we have been reading reports also. But today, when you presented, it is helpful. Firstly, I would like to thank each one of you. I wanted to know what kind of suggestions you will recommend to town planning offices or to government bodies so that affordable housing can be promoted. What I could draw from the figures is now luxury housing is taking a pace, and because of multiple reasons, as we discussed during presentations, affordable housing sale is down. So what will be the suggestion? Divyesh or Prashant or anyone, Vimal?
I will share a couple of things. It's not the suggestions to any particular entity, but in general, I think because of the price escalations that we have seen in the land and the interest cost, which is a function of the demand today for the other categories of housing, maybe infrastructure push will definitely help, because the travel time from satellite locations to the workplaces have to be reduced. So, providing good infrastructure could be looked into. There could be development of satellite townships or something like CIDCO. CIDCO has come out with the availability of land, and then the construction is taken place on that. And there are a lot of public utilities. It is near to railway station, near to there are best buses available. So when all this becomes available, the applications have been 3 times of the supply that they have seen in CIDCO. So something like that needs to be worked out. I understand from the question that Rakesh said, and somebody would have raised, that there are a lot of many houses which are vacant. I have also heard that as we do ratings, we have seen that construction has happened. Maybe sales have happened, but those have not been occupied. And when we speak to the people out in the market, we realize that they are far off locations, and traveling from those locations has been very difficult for the people residing out there. So I think they have again moved to the city area in whatever available stays they would be doing. They have moved back there, but are unable to stay in those locations because they prefer public transports, and their children would be going to school and all, for which also transport is required. And water availability is also an issue, is what has been heard. So there is a difficulty
So
out there.
Divesh, what I draw from your answer is like if we talk about infrastructure improvement, so government has recently started constructing regional road transport system so that people staying in maybe satellite town can come to city center and work. But what is happening is these 10 lakh odd units which are already constructed in these satellite towns, those people are not ready to travel because of infrastructure inavailability. But wherever even the infrastructure is there, the people do not want to stay, say, 30-40 kilometers far from the city center. So, planning norms of TUD, TDR,
Or
and
they're
increased
bringing
FAR.
more FAR or bringing more FSI or
But when we say bringing more FSI, like I wrote in chat box also, Singapore is having 15 or 20 FSI. So if in India, maybe because of seismic zone 4 in NCR, we cannot go that taller. In Mumbai, MMR, you can go taller. But what other options we can explore?
rental housing can be
But if we go taller, so construction cost will go higher, so we cannot go affordable.
the affordable
So
definition.
shouldn't be I'm cutting in between many times, sorry, but shouldn't it be like multiple city centers should be brought in, like just having central districts at one place, the commercial setups at multiple places should be there so that people get employment nearby.
See, what happens is the biggest service provider in India is either Bangalore, Mumbai, or NCR as of today. The town tier 2, tier 3 cities, but the employment generators are in these cities. Or so we see a lot of shift which is happening in Bangalore. We see the factories moving. Sorry, in Mumbai, the factories moving out to Vapi side or the Gujarat, the beginning of the Gujarat. So when these things take place, and the development of a complex or housing societies by the industrialists happen, because manufacturing is a big contributor of GDP in India. So if those industries provide some housing, maybe ownership basis or rental basis to the workers out there, a large proportion can be taken care of. There is a lot of public land available. If that can be brought in by the government along with, then the construction costs can be taken care by the private players, and more taxation benefits are given for the developers. So that can also be taken care of for the supply that comes in. Now, there is if you look at the countries outside of India, it's huge rental accommodations that the government provides. So there was something under PMAY for which rentals would be provided, but if that is also looked into for a long leases and not short leases, like in India we generally do short leases, we will do a long leases with them, and which is taken care by government, maybe in PPP form, wherein the developers get some fixed contract. Maybe I'm just thinking out of the box as I talk to you. So these things can bring in a decent supply, and that supply should also be habitable. Like certain photos I'd seen of some affordable housing projects, the walls started falling off, and the ceiling fell off. The construction quality was so poor. So we need to take care of the construction quality of those people who are going to reside, and provide them a habitable place to reside with basic utilities like maybe hospital, pharmacy, maybe some school around for the children. So we have seen that in outskirts of Mumbai happening as well. But there will be pockets where supply is there and and it has not been occupied. So lot of things have to go into. Decade back, it was all there, but I think after COVID, the developer shift has been towards high-end projects because of the margins that are generated now in the luxury projects.
Mr.
My
Shah,
colleagues
meanwhile,
also,
Mr. Shah, you mentioned about PPP in real estate. So, is there any example? While I was working in Middle East for some time, there are many projects. Those are solely dedicated for rental housing and made through PPP models. There are cases in US and other parts of the world also. Any example in India? Have you come across that? The entire township is built by the developer with the support of any government authorities, or any study on this?
you're asking me?
Yes,
Yeah.
you or anybody.
I have not heard of it. As I read and as we discuss with a lot of developers, this things comes to our mind. But I have not come across as from the ratings perspective. Maybe my colleagues, if they have done some research or something for their clients.
Bimal or Prashant, anybody can pitch in, please.
Yeah, hi Avinash. Not really. I don't think so. I've really come across any notable PPP, but Personally, I feel one major issue in affordable housing, which compared to at least certain countries like China and Singapore, is I think it's just the utilization of technology and the level of technology in mass housing. I think that can be a major differentiator in India because we have, to an extent, similar dynamics when we talk about the need for mass housing. I think that's for some reason we have not been able to cope up and adopt to it. I think that should be a game changer going ahead.
Traditional mentality of the developer or contractor in India is when you bring in technology, the cost will go up, although it's vice versa.
I
So how do you tackle about it?
No, so I feel that is what I'm saying. It's the end of the day, it's a business, and as long as I think people tend to make money out of it, I think there will be enough motivation. And time and again, I think in different forms, if we talk about budgetary provisions, the government has shown there is focus on affordable housing. I think that is the way to push to begin with. It has to be some form of reform, some form of regulation through which it gets pushed. I know this has been also happening, but still the progress has been slow. But that is the only way out, I think, because ultimately they have to see stakeholders have to see merit in terms of commercial takes as well as in terms of actual application. It's more about technology.
I think also the role of state government is very critical rather than the central government in real estate.
Yes, it's
The more proactive the state government is, I think that is very important.
that is true.
Okay.
Which is why I think sometimes we see everything being developed and which is in far-flung areas and people really do not want to go because everything could be there, but there needs to be a proper ecosystem wherein there is there is employment opportunity, people are able to work there, people are able to live there. It has to be a proper city. You can't just build a city with certain infrastructure and expect people to move. So it is going to be slow, but I think it will happen sooner or later.
So I think we are already overshooting by 10 minutes. So it was an excellent presentation by all three our speakers. So I would like to thank Mr. Devesh Shah, Dr. Prashant Thakur, Mr. Vimal Nadar for their thought-provoking talks and presentation, and also the participants who attended today's webinar. We would look forward to your next webinar on January 17th, which will be on the Indo-German opportunities in the infrastructure and construction space. And with this, we would like to close today's webinar. And before that, I would like to wish all of you a very happy New Year in advance. Have a great 2025. Thank you.
Same to you. Thank you.
Thank you very much, Mr. Rakesh. Thank you,
Thank you.
everybody. Thank you, Avinash.